What would you do if your billion-dollar empire crumbled overnight? A chilling question, isn't it? But for the Lehman Brothers, it was a harsh reality. In the year 2008, the world watched in astonishment as the fourth largest investment bank in the United States filed for bankruptcy. It was a shockwave that rippled across the globe, triggering a financial crisis of a magnitude that had not been seen since the Great Depression. The Lehman Brothers was not just any bank, it was a titan of Wall Street, a symbol of American financial might. Its downfall sent a clear message: if Lehman Brothers could fall, then no financial institution was safe. This was not a storm in a teacup, but a tempest that threatened to engulf the entire financial world. Imagine the panic, the uncertainty, and the fear. Imagine the questions that raced through everyone's minds. How did this happen? Who was responsible? And most importantly, could it happen again? In today's discussion, we will unravel the events leading to the Lehman Brothers crisis. Lehman Brothers was not always a symbol of financial catastrophe. Quite the contrary, the firm was once a beacon of financial prowess and innovation. Born in the mid-19th century, in the year 1850, Lehman Brothers began as a humble dry goods business in Montgomery, Alabama. Founded by the three Lehman brothers, who were German immigrants, the firm initially traded in cotton, a commodity that was the lifeblood of the Southern economy at the time. As the business prospered, the firm ventured into the railroad industry, underwriting its bonds, a move that marked its transition into the financial services sector. By the dawn of the 20th century, Lehman Brothers had grown into a full-fledged investment bank, making a name for itself on Wall Street. The firm was known for its innovative approach, which was evident in its role in developing the initial public offering market in the 1920s. Lehman Brothers was instrumental in taking public many well-known companies, like Sears, Roebuck and Company, thereby playing a pivotal role in shaping America's corporate landscape. But it wasn't just about innovation for Lehman Brothers. The firm was also renowned for its resilience. During the Great Depression, while many banks crumbled under the economic strain, Lehman Brothers managed to not just survive, but even thrive. They diversified their investments, focusing on venture capital and forming a private equity division, an initiative that was ahead of its time. The firm's success continued well into the late 20th and early 21st centuries, with Lehman Brothers becoming one of the leading global financial services firms. The firm was involved in everything from investment banking and equity and fixed income sales and trading to research, investment management, private equity, and private banking. Their business model was built around aggressive growth and high leverage. They took on significant risks in pursuit of high returns, a strategy that seemed to pay off as their profits soared in the early 2000s. However, their success story was not to last. The seeds of disaster were sown with the turn of the century. As we entered the new millennium, Lehman Brothers, once a paragon of Wall Street, began to alter its business model. The conservative approach that had served them well was abandoned in favor of a more aggressive strategy. The firm started focusing on high-risk investments, particularly in the realm of subprime mortgages. Subprime mortgages were loans given to individuals with poor credit histories. They were considered high risk for default, but they offered high returns. Lehman Brothers, intoxicated by the potential profits, plunged headfirst into this risky venture. The firm began investing heavily in mortgage-backed securities, essentially betting on the continued success of the housing market. At the same time, an economic phenomenon was taking place across the United States. The housing market was booming. Property prices were skyrocketing, and the demand for homes was insatiable. This housing bubble created a false sense of security among investors, including Lehman Brothers. They were under the impression that property prices would continue to rise indefinitely, and as such, their investments in subprime mortgages seemed foolproof. However, as is the nature of bubbles, they eventually burst. By the mid-2000s, the housing market began to show signs of strain. Homeowners started defaulting on their loans, triggering a domino effect that would shake the very foundations of the financial world. Lehman Brothers, heavily invested in these mortgage-backed securities, found itself on shaky ground. As homeowners defaulted on their loans, the securities Lehman Brothers held began to lose their value. The firm was left holding the bag on investments that were quickly becoming worthless. When the bubble burst, Lehman Brothers was left vulnerable. The firm, which had once stood as a titan of Wall Street, was now teetering on the brink of disaster. Their risky business model, coupled with the collapse of the housing market, had set the stage for what would become one of the most significant financial crises in history. But, as we'll see in the next scene, this was just the beginning of their troubles. In 2008, the unthinkable happened. Lehman Brothers, a titan of Wall Street, filed for bankruptcy. This event sent shockwaves through the world and marked the largest bankruptcy filing in US history. But this was more than just the fall of a financial giant. It was the ignition of a global financial crisis, a crisis that would reverberate through economies worldwide. Lehman Brothers was a cornerstone of the financial industry, a key player in the world of high-risk, high-reward trading. Its collapse sent a chilling message. If Lehman could fall, so could any financial institution. The confidence that had once been the foundation of global finance evaporated almost overnight. The impact was immediate and far-reaching. Stock markets plummeted, businesses buckled, unemployment soared, economies across the globe slipped into recession as the financial system teetered on the brink of collapse. It was a domino effect, a cascade of failures triggered by the demise of Lehman Brothers. But how did this happen? Lehman Brothers was not a small player. It was a financial behemoth, with a history dating back to the mid-19th century. Its failure was not just a result of poor business decisions or financial mismanagement, it was a systematic failure, a breakdown of the checks and balances that were supposed to protect the global economy. The Lehman Brothers crisis was a wake-up call for regulators and policymakers. It exposed the vulnerabilities of the financial system, the risks associated with unchecked speculation, and the dangers of an over-reliance on debt. It showed that even the mighty could fall, and that the consequences of such a fall could be catastrophic. The fall of Lehman Brothers marked the beginning of a global financial meltdown. It was a crisis that would take years to resolve and would leave a lasting impact on the world economy. But it was also a critical moment, a turning point that would change the world of finance forever. The collapse of Lehman Brothers served as a grim reminder of the perils of unchecked risk-taking. The fallout from this monumental collapse was far-reaching, plunging the global economy into a deep recession. Millions of people lost their jobs as companies downsized or shuttered their doors, and the unemployment rate skyrocketed. Other financial institutions teetered on the brink of collapse as the crisis rippled through the financial sector, and even the stalwarts of Wall Street were shaken to their core. The impact was not just confined to Wall Street or the United States. It reverberated across borders, affecting economies worldwide. The Lehman Brothers crisis was a stark reminder of how interconnected our global financial system truly is, and how a single failure can trigger a domino effect. The aftermath of the crisis also underscored the importance of risk management and regulatory oversight. It served as a wake-up call for companies to tighten their risk controls, assess their exposure to potential crises, and ensure they have robust contingency plans in place. The crisis also highlighted the need for regulators to maintain a vigilant eye on the financial industry, ensuring that institutions are not taking on excessive risk and that they have adequate capital to weather potential storms. The Lehman Brothers crisis also brought to the fore the role of clearinghouses in the financial markets. As the crisis unfolded, clearinghouses were thrust into the spotlight as they took on the risk when one side of a trade defaulted. This has led to increased scrutiny of these institutions, with regulators conducting stress tests to ensure they have enough capital to handle increased volatility. The lessons from the Lehman Brothers crisis are numerous, but perhaps the most important lesson is the need for vigilance and preparedness. No matter how robust a financial institution may seem, it is not immune from failure. And when such a failure occurs, the impact can be devastating and far-reaching. The Lehman Brothers crisis was a wake-up call to the finance industry and regulators worldwide. So, what led to the downfall of this financial giant? It's a culmination of several factors. The shift in Lehman Brothers' business model was a significant contributor. They veered from traditional banking, engaging more with risky investments, particularly in the housing market. This shift, combined with an economic climate where housing prices were skyrocketing, created a precarious situation. As we've seen, when the housing market bubble burst, it had a catastrophic impact on Lehman Brothers. Their heavy investment in subprime mortgages backfired, leading to massive losses. The situation was further exacerbated by a lack of regulatory oversight, which allowed these risky practices to go unchecked. It's crucial to note that Lehman Brothers' downfall wasn't just a company's failure, but a reflection of systemic issues within the financial industry. It highlighted the dangers of over-reliance on risky financial instruments and the need for stronger regulatory frameworks. The Lehman Brothers crisis serves as a stark reminder of the consequences of excessive risk-taking and the importance of prudent financial management.